We have our guest speaker, Bill Poirier. Bill and I have known each other for about a decade now. He has been in the lending industry for over 30 years. He's currently a senior loan officer at the Westboro branch of Draper and Kramer Mortgage. And so today, what we wanted to talk about is because the Fed, and they just announced this too, is going to continue to keep interest rates at or near zero. We wanted to talk about mortgages and refinances, whether you're a first-time home buyer or you're looking to take advantage of the really low interest rates to refinance, either to free up cash flow or to kind of shorten the length of the term of your loan. There's a lot of opportunities in the market right now. Anything you want to share, Bill, before we kind of get started?
Well, I guess the thing that's probably most obvious from where I'm sitting today is that in 2020, we saw something very unique, the entire world. And as a result, the mortgage industry experienced a significant boom in mortgage originations. And that was simply a result of the federal government and its stimulus package being a lot more aggressive in buying mortgage-backed securities. So inevitably, it drove rates down. And the blessing to that is it's been able to provide opportunities for so many folks to refi and buy. But the consequence to it is because money has become so much more affordable, there is a significant push of a lot more buyers into the marketplace, which is adding to an already existing problem of an equal balance of buyers and sellers. And right now, the sellers are few and far between. There's probably a good 20 buyers for every house out there right now. And it's made it challenging for buyers to be, in a marketplace where their offers are not being considered because there's 20, 30 offers and people are willing to spend more than a house is worth. And that's the biggest observation and comment that I'd like to at least share, because whether you're a buyer, whether it's your first time or you're trying to move up, there are some challenges that are very different and unique today than we've ever seen before.
Certainly. I have some clients that are first-time home buyers that are bidding on houses where there's 20, 30 offers and just going well over asking. So
Yeah.
let's kind of start with the first-time home buyer and kind of graduate our way to clients that may be in a more sophisticated situation. Sure. If you are a first-time home buyer, how would you think about the home buying process in terms of how much house I can afford?
Oh, sure. So the first thing that we want to recognize is that Fannie Mae and Freddie Mac, even after the housing collapse, in my opinion, will give consumers enough rope to hang themselves again. So when a first-time buyer is considering where they need to be, the first thing we like to try to identify is, where is their budget? Have they created a budget? Do they know where their numbers are? And I got to be honest, most folks don't. Most folks have a number in mind based on what they see online, and then they try to work backwards to make sure that that fits their budget. And in many cases, maybe it does, maybe it doesn't. But when we work with folks, particularly on their first home, what we're really trying to do is establish, say, 3 or 4 different price points, and we want to have them judge that price point based on whether or not those monthly payments fit their budget. And inevitably, whatever you're paying for rent, you're more than likely going to always spend more for a mortgage payment. So in our industry, we talk about this thing called debt to income ratios. And I like to see my first time buyers not exceed 35% of their household income as a gross income. We don't want to see them exceed 35% for a housing expense. Now, we live, unfortunately, in a very, very expensive part of the country. And so what we're seeing is a lot of first-time buyers having to push that number. And the lending industry will give them more latitude to do so. But we try to caution them to make sure that they're not putting themselves in harm's way, because those mortgage payments have a funny way of showing up on the first of the month, and they like to be paid attention to.
I guess another precursor question is how far in advance should you get a pre-approval letter?
Uh, I can't stress enough to the folks that reach out to me. I encourage everyone to do the pre-approval process 6 to 12 months before they decide to buy. And the reasoning behind that is we've learned through the process of the due diligence that sometimes folks are completely unaware of their situation and how it could negatively impact their ability to buy. And so what happens is we have two types of clients. The client that comes to us 6 to 12 months before they want to buy, and we're able to make sure that there are no credit issues that they're unaware of, that there is an income stream that is reasonable and allowed to be used for qualifying purposes. And then there's the client that reaches out to me on a Friday who hasn't been pre-approved, is going to look at a house on a Saturday and wants to get that taken care of right away. And the problem with that is that person's not prepared. So for if there's any unexpected surprises, they're disappointed because they can't get past the go because, well, maybe they didn't realize that that medical bill that they forgot to pay is now in a collection status, and it had a huge impact to their credit score, which maybe disqualifies them for mortgage financing altogether. So when I'm talking to folks that are just casually thinking about it, I remind them there's no cost, there's no obligation. It's simply an opportunity for us to make sure that there are no skeletons in the closet that you're unaware of. And I can speak to that particular issue on a very personal basis. I Joe and I, my wife, bought our very first house in 1994. And back then the process was vastly different than it is today. But through that process, there was a credit card balance that both my wife and I were completely unaware of. It was a $3,000 collection account with Sears. Now, the odd thing is, I don't have a Sears account. And I thought, well, possibly my wife had one and I didn't know about it. She confirmed, no, we did not have a Sears account. Well, it turns out that account was my dad's account, and I'm a junior. So we figured this out because I was born in 1966 and this account was opened in 1961. But it created a tremendous amount of stress because back then you didn't necessarily go through the the pre-approval process. You just found a house and you applied for financing. So we like to remind folks, sometimes it has nothing to do with you. Sometimes it's a mistake. Sometimes it's erroneous information. Sometimes it's something that did take place that you were not aware of the significance. So Sarin, you know that at one point Joe and I lived in San Diego. Well, what people don't realize in other parts of the country, certain activities are reported to credit reporting agencies. So if you got a parking ticket in the city of San Diego and you did not pay it, that was an account that was reported to the credit reporting agencies. So your credit worthiness was now being determined based on your forgetfulness of making a $25 parking ticket. Yeah, so we encourage folks, it's never too soon because you don't know what lies beneath.
So in terms of credit, how much does that actually affect the interest rate that you get when you're applying for a mortgage?
It has the most significant influence. It not only determines eligibility in terms of whether you can or cannot get a mortgage, it determines the down payment, and it has a huge impact on the cost of the financing. And that's something that has evolved. So back in 1990, when I got into the mortgage business, rates were published and those rates were available to everybody. Credit score was not factored into that equation.
Mhm.
And over time, the agencies, Fannie Mae and Freddie Mac, have gone through the process of evolving and changing how risk is assessed. And risk is assessed based on somebody's ability to demonstrate their their capability of managing credit in a prudent manner. And when somebody unfortunately doesn't manage that credit in a prudent manner, then the risk is higher that that loan will inevitably end up either being foreclosed on or with some sort of derogatory deficiency issue. So we've seen as much as a 2% increase to an interest rate based on somebody's credit score.
Wow. And let's break it down to numbers. Are there credit score ranges that you say, okay, this is the lowest range, the middle range, and then if you are in this range, that means you're going to get the top or best interest rate?
Sure. So credit score, there's something termed FICO score. It's the Fair Isaac Company. They have created the algorithm, the math behind the calculation of creating a score. When I work with folks, I tell them, listen, if your credit score is 740 and above, you are walking on water and talking to God kind of credit. You have stellar credit that makes you eligible for the most attractive interest rates. As you drop down in increments of 20, so if you're at a 700 or a 680 or a 660, each incremental drop of 20 points on that FICO score has an impact to the rate that you're going to be offered. As far down to 620. When you start going below 620, your credit is, you've demonstrated that you've not managed your credit very well at all. And that the likelihood is you will not be eligible for a mortgage. And if you are, you may end up having to take something like an alternative type of mortgage, even an FHA mortgage. FHA does have the ability to provide financing for credit scores below 620, but when they price that risk out, it can be pretty significant. You could have a marketplace that offers best rates at 3% or 2.75, and somebody with a 620 credit could be 5%. There's that much of a hit for credit scores that are below 620, and a score that is 740 and above is always going to get the best price possible.
So any tips or tricks on how to build up a good credit score so when it is time to buy a house, you're putting yourself in a good position?
Yeah, the most obvious is make sure you pay your bills on time, right? But there are some other strategies that a lot of folks are not aware of that has a huge impact to giving you the benefit of a better score. It's called the utilization rate. So let's assume that you have a credit card that has a limit of $10,000. When your balance exceeds 35% of the limit, you automatically lose points. And the higher that percentage of your balance is relative to the limit, the more points you lose. So if somebody has three credit cards, and one of them has got a $10,000 limit with a $10,000 balance, they would be better off doing a cash transfer and spreading out the $10,000 over 3 credit cards, because then that utilization rate is below 35% for each one versus at 100% for one. So sometimes it's a simple, just an evaluation of where that credit balance is versus the limit.
That's a great tip.
Yeah.
Thank you. Another very common question I get is, what is the difference between the interest rate and the APR?
That is the number one question we get all day long.
Okay.
So the interest rate is what determines the principal and interest payment associated with borrowing a set dollar amount. But the federal government has said, listen, for a consumer to be educated and understand how to shop more effectively amongst 2 or 3 different lenders, we're going to require lenders to disclose something called an APR, an annual percentage rate. And so that mathematical calculation takes into consideration the following sets of terms. It takes into consideration the interest rate you pay, any mortgage insurance you may or may not pay. It takes into consideration certain closing expenses, and it takes into consideration the life of the loan. So if a consumer calls 3 different lenders and each lender is offering us the same rate of 3%, but lender A has $5,000 in closing cost, lender B might have 7, and lender C might have 10. Well, it gives, in each one of those examples, the lender that has the greater closing expenses is going to have a greater APR. what they're trying to help consumers do is identify not only the interest rate, but the cost to obtain that interest rate in closing costs amortized over the life of a 30-year mortgage. So it's just a nice way to be able to help a consumer better understand. Now, many times the consumers that we work with, it's not about comparing one lender to another. It's just trying to help demystify, well, why is my interest rate 3%, but my APR at 3.5%? And the explanation is, well, you're paying 3% for the mortgage, but you might be paying another 25 basis points for monthly mortgage insurance. And then a certain portion of those closing costs amortized over 30 years is costing you another 25 basis points. Therefore, your annual percentage rate, the true cost of borrowing the money, is 3.5%, because it's not just about the interest rate that you lock into and borrow against, it's the money you spent to obtain a mortgage to get that rate.
Thank you for that explanation. We didn't spend too much time on refis. I would say that there are very few situations these days that it doesn't make sense to not refi. So I'm going to pose the kind of the reverse question. Is there a situation where it does not make sense to refi given the current interest rate environment?
Absolutely. So there are actually more opportunities to not refinance than you'd realize, even with such a low rate environment. A perfect example is somebody comes to me and says, I have an interest rate of 4%. I want to refi because I hear rates are low.
Mhm.
Okay, well, so we're going to do a little due diligence. And one of the questions we're going to ask is, well, how long do you plan on being in this property? Oh, well, we're going to sell it next year. But while rates are low, I thought we could save some money. And so mathematically, that might seem like an appealing, right thing to do. But when we factor in the cost to refinance, if you're going to save $200 a month, but it costs you $3,000 to get that $200 savings per month, well, in 1 year, you're only going to net $2,400 in savings. And then if you sell in that timeline, if you spend $3,000 to save 2,400, you lose.
Right.
So many times what we're trying to do is identify, yes, it seems based on the pure math that you're going to put yourself in a better position, but let's dive deeper into those numbers to make sure that your horizon of how long you plan on holding on to this property or this mortgage puts you in a better position. And we utilize a tool that helps us create that visualization. It's going to show the consumer what the monthly payment is, the savings looks like, but we're going to show them what that savings looks like over 5 years and over the life of the loan compared to their existing mortgage. So we're going to demonstrate and show them, all right, here's where the real value is.
Mhm.
But if you're going to sell in a year or two, depending on the math, it just doesn't make sense to do anything. Doing nothing sometimes is your best choice.
Honestly, that's one of the things I appreciate the most about you is that due diligence process. Whereas some other lenders or institutions will just give you what you ask for.
Right.
Whether or not that makes financial sense, it's much more of a transaction for them versus, let's look at this on a holistic level and figure out, does this make sense? Is this actually going to benefit you or not?
Right.
So I think that is extremely key, whether it comes to your mortgages or your financial planning, is doing that due diligence and taking the time to run the numbers and do an analysis to say, okay, how does this benefit me? So thank you for that.
Oh yeah, my pleasure.